Today, we're looking at the age-old question of whether there's a difference between funding income protection outside of super or inside super. Let's have a look. So let's do an apples for apples comparison of funding income protection through super or outside of super. So we'll start with the underlying assumption that $1,000 of income protection is being purchased. So our net goal is to fund $1,000 of insurance premium. Let's start by looking at the outside of super cash flow. So if our client is on the top marginal rate of 45 cents in the dollar plus 2% Medicare, we know that a gross salary of $1,886.79 needs to be earned. Of that taxable salary, we know that the tax payable is $886.79, leaving a residual amount or disposable income of $1,000, which will be used to fund the insurance premium. The insurance premium, being tax deductible at the client's marginal rate plus Medicare, would attract a tax deduction of $470. So the net tax payable is $416.79, meaning the client's end of year tax position is that they will receive a tax refund of $470, plus they will hold $1,000 of insurance. Let's now do a comparison and an apples for apples comparison. So we've got to start at the same top line gross salary required. So if a client is going to be funding their insurance through super, we can't just start at the $1,000 insurance premium. We need to follow each line through. So starting at the gross salary of $1,886, we'll compare what happens from there. So the client would be salary sacrificing $1,000 that will then be used through the super fund to purchase the insurance. But we can't ignore the $886.79 that has also been earned. So let's follow this amount through first and say that $886 will attract 47 cents in the dollar tax. So $416.79 of tax will be paid, meaning that the client will receive a net cash salary of $470 cash in hand. If we now look at the salary sacrificed amount of $1,000, we know that on its way into super, it would attract the contributions tax of 15%. However, as the super fund will use that $1,000 contribution as an expense to pay the income protection, it will receive a deduction of that $150. So the $1,000 that's gone into super will be used to fund the insurance premium, and therefore the client will hold $1,000 of insurance plus have received $470 cash salary net after tax. So we can see, comparing side by side, we can see that in both situations the client ends up with cash in hand of $470 and holding insurance of $1,000. The only difference in either scenario is the timing of when they receive the $470. If they're funding the insurance through their cash flow, the $470 they receive is at the end of year when they receive their refund. If they're funding the insurance through super, they will receive the $470 as part of their ordinary salary. This has been Eddie from Curto Consult. Thanks for watching.